This is CNN.
The S&P 500 has been hitting record highs, and so far this year it's about 10% higher than it started. But analysts say the index could move maybe 1% higher before we see a pullback. So where should you have your money? The most basic rule of investing is this: risk and reward go together. What you have to decide is how much risk you can stomach or how much reward you'd like. Three of the best minds in investing join me now. Sarat Sethi is a portfolio manager at Douglas C. Lane & Associates. Jim Awad is managing director at Zephyr Capital Management. Doug Flynn is a certified financial planner at Flynn Zito Capital Management. These guys have been advising you on my shows for more than a decade. I'm going to ask you all the same question. If you believe that there is another percent in this market, that's not enough for most people. They can't in April throw in the towel and say we're done. How do you squeeze more out of an investment without taking undue risks? All right, let's start with you.
So I think when you're looking at the market, you're talking about an index. So we want to look at it as sectors and stock specific. So the time to rotate out of sectors that have done really well, i.e. some of the media companies, some of the utilities, some of the consumer staples, go into areas that are still undervalued, maybe the autos and some of the industrials, some of the techs. That's where you make the money, is finding the difference in the market that's undervalued and overvalued.
Finding the deal.
Exactly.
Now you can't just throw your money at the market. Now you say, look, maybe the market pulls back, but I got places that are still undervalued.
There are parts of the market that are still, we think, have a good way to run, especially over the next 3 to 5 years.
Jim. Well, the way I would answer the question, if you believe the market's only going to go up another 1% and you want to get a return greater than that, is to buy dividend-paying stocks. But it's got to be a dividend-paying stock with good fundamentals, a well-covered dividend, and a dividend that could grow. So it leads you to large-cap multinational companies with good balance sheets and a dividend you can have security. Right. And many of them are 3 or 4%.
What do you do in the case where a company is paying a 3 or 4% dividend, which is better than you'll ever get in a bank account or a bond fund, but there is some worry that some of those might be at the top of their valuations too.
Well, if you're not in and you believe that and you want to get in, you might buy maybe half the position right now because the market has had an extraordinary several months. And then when the inevitable pullbacks come, buy the rest of it. That way you're not totally at risk right now.
Doug, the fixed income, things have had a bad name recently. They're getting a bad name because when markets are running 10% in 3 months, people say, why are you in the markets? Why are you in something else? Right. Yield is not there. But you don't think people should go too nuts about that. If fixed income is part of your risk strategy, then you should stay in it.
Well, most people don't want to have 100% of their money in the equity markets, no matter how diversified they are. Most people have some combination of fixed income mixed in there based on their risk tolerance. But even within there, a lot of people do know how to diversify on the stock side, but they really don't know how to do it on the fixed income side. So we're talking about treasuries and all the risks that are in treasuries, but there's a lot of opportunity in other places, whether they be flexible income funds, emerging market debt. There's a lot of different things that you can get into that will enhance and diversify and build you an additional yield, and then allow you to rebalance and take advantage of that.
You're a financial planner. People must come to you at times like this when markets are going well, saying, I want to get into the market. Do you put anybody into individual stocks?
Oh, sure. I mean, there's a time for individual stocks. I mean, there are places where you can bring some value in that versus just outright indexing. But what we really look at is a year ago you have to look at growth versus value. It's an easy way to eke out some extra return versus just looking at the market overall in the S&P. So a year ago when you had growth outperforming value, you could rebalance accordingly. And now a year later, the exact flip-flop has happened. And so you could just rebalance back and forth between those, and you're going to create some additional return versus just hanging on in one particular place.
Okay, good. So we've given you some broad strategies. They're all three different. After the break, we're now going to tell you exactly what you do to keep your portfolio growing. So not just stick around, but come back with a pencil and paper. So one point that my three guests have made is that don't get nuts about looking at the market. By the way, it's Sarat Sethi, Jim Awad, and Doug Flynn. Don't get crazy about these market indices, because while much of your investment or some of your investment should be in something that looks like the S&P 500, the bottom line is this is a world made out of mutual funds, sectors, industries, and geography. So I want to go through with my three guests exactly what they would recommend someone do right now in this market where we have little pullbacks, Jim, but largely this market has been going in one direction since the beginning of the year. And in fact, when you really broaden it out, it's been going in one direction for a long time, up. So we are not, the low-hanging fruit for investors may be gone. What do you do now?
Well, you go with established companies that have a global footprint, that participate in the emerging markets, have a good exposure to the recovering U.S. market, that have good balance sheets and good dividends, as I was saying. And I would use companies like Microsoft, GE, and Intel. All have between 3.5% and 4% dividends and stable business models and fortress balance sheets. So that's going to do as well as anything.
So they are safe. They're not exposed to much interest rate risk. They sell their. I wouldn't. You know, I don't know anybody but Microsoft and Intel and GE want to be called boring, but they've got steady businesses that don't fluctuate too much based on changes in the economy.
Yeah, if you can grow the revenues 2 or 3%, earnings 5%, and get a 3 or 4% dividend, that's a good total return for somebody looking to put their retirement money to work today.
Okay, so you are emphasizing that yield, the dividend, the money that it throws off, plus the fact that the stock may appreciate in value. If somebody still wants yield, the idea that you want to be somewhat conservative, but you can't put your money in a bank, what do you recommend?
Well, you start with your typical fixed income. We're back to fixed income again as the offset to the equity side, and you need to diversify that. So 10% of the portfolio, we keep talking about emerging market debt. The reason I like it is because if you take emerging markets versus developed markets, you've got their debt to GDP is 1/3 of what typical developed
Believe it or
markets
not, that's the backwards of what it used to be in the old days.
Exactly. And yet they're growing at 4 times the rate. So there's an opportunity there. It doesn't need to be a big part, but the yield is about twice the yield of a 10-year treasury. Now, they're going to have the same risk level as an equity, but the opportunity is there for enhancing yield without chasing high-yield corporate debt too much and getting into very, very ultra-risky assets.
Do you have ideas?
Well, there's an ETF that you can certainly look at. The biggest one out there is hedged back to the U.S. dollar, so you don't have the currency risk. But you can certainly get on the ETF database and search for emerging market debt funds. That one right there is the largest ETF out there in the space. But there are some that are not hedged, so you have currency that you bring in, and so you'd play that. But this is a very straightforward way. Institutions, pension funds have been using this as a small part of their portfolio for a long time.
It's a hedge.
Most people haven't.
All right, and that's a very good idea. A lot of these ETFs, which are exchange-traded funds, they trade just like a stock. So if you have a trading account, you buy them. They have a ticker, and this has been a tool that the pros have been using for a long time, but they are actually open to regular folks. You're a stock guy. What do you think people should do?
I think you look for secular growth. I think you look for companies. I totally agree with Jim. You want strong balance sheets. You want growth also. You want companies that have free cash flow. So you look at a company like a Google that is secular growth. More people searching, more people going on mobile, and their share keeps on going. And as they increase that, they're going to get more money. The stock sells at 14 times earnings, growing 10%. So in the same vein, look at a Qualcomm, which is wireless technology, 3G, 4G, more chipsets. Everybody's got a smartphone. They're getting more than one.
But these guys win no matter what happens. So there's a smartphone battle going on, and Qualcomm wins either way.
They're agnostic, whether it's Nokia actually leading, or if it's Google leading, or if it's Apple leading, because the chipset is either being made by them or they get a royalty for them. And then on the other side, is look what's happening globally. Auto sales are going up. So what companies are producing the best products? What have a good balance sheet that's growing a dividend? Ford has a 3% dividend. Didn't have one a couple years ago. Increased it. They're investment grade, and their products are selling. In fact, every quarter they're doing better and better.
Strong management, strong product lines.
Exactly. Secular growth. Get rewarded on the income side, on the balance sheet side with protection, and also you get to grow over a period of time.
So when you say secular growth, I want my viewers to understand what you're saying is they're not dependent on larger economic growth necessarily.
Exactly.
They can grow in their area, and their area is growing.
They are dependent on what they produce and how competitive they are within the same industry or within the whole competitive landscape of different stocks you can invest in.
All right, listening to this, you can get better than your 1% out of the market. Guys, great to see you. Sarat, Jim, and Doug, it's been a long time for the three of you, and it's good to see you again.
Pleasure.
Some of the best advice you're going to get financially. Coming up next, some news of my own. I'll be right back with more of Your Money.